achieve it.
That one wasn't me, but
and another thing.
It was good fun when it
good
happened.
at many things. Putting the boot into someone when they're down is.
I prefer not to have got that reputation, but
I tell you what, you are. Well, probably not a bad time to introduce the show. Hello, everyone. What episode are we on? Episode 14.
Yeah.
Episode 14 after the bell. This week with Oli Creasy, property analyst, and also I think the funniest man in the firm.
Wow.
That's a heavy crown to be.
I mean, you ain't got
to
much
wear.
competition, mate.
Okay, fair enough. Okay, that's good. Is it funny or funny to look at? I mean, that's the big question.
I
right?
think you're very humorous, and
I
anyone that
appreciate
snakes peep show quotes into analyst notes with the regularity that you do, you really. In the dark days of 20, I looked forward to those.
That was a highlight. I got a lot of feedback. That was my most read note, I think. Which says a lot about the quality of my output, doesn't it?
How's life in property land at the moment?
We're getting by. I think is as much as I can say, to be completely honest. Property land is not it's not thriving. That's a fair comment.
No.
2022 was a pretty nasty year for anyone in the sector, whether you were a REIT analyst or owner, or indeed a direct property owner. Values in commercial property fell about 20-25%, more or less across the board. That's what rate rises did for the sector, and there wasn't really anywhere to hide, and there still isn't really anywhere. Maybe we're done hiding because the damage has been done, but there's not an awful lot of good news.
No,
to be completely honest.
No, I mean, totally anecdotal, but 5 properties have gone up for sale on my road in the last 2 weeks. I think it's buy-to-let sales, personally.
Yeah,
well, rental property sales, basically.
When you take interest rates from 0 to 5.5% in the space of 18 months, it's going to be damage.
I feel like we've had that sort of Mexican standoff period where there's no transactions, and now
it's beginning to wash through.
They're starting to see it wash through. When you say at dinner parties what you do people constantly ask you about house prices?
What's actually funny is no, they don't. So I've got friends who are doctors and lawyers, and they're constantly getting asked, does this look infected or whatever. I can
just in between.
You probably ask the lawyer, oh, do you think I should get, how should I divorce my wife, or whatever question you ask the lawyer. I can count on my thumbs the number of times people have come to me for property advice.
Really?
on my days off. Yeah, no, because everyone in the UK is already an expert on housing.
Yeah, everyone in the UK thinks they're an expert in property because we've been in a 30-year bull market for property. You never get your house valued. When you do, it's inevitably usually gone up, and leverage amplifies the return.
Yeah.
So everyone thinks they're a guru.
Well, and you don't benchmark it against anything else, right?
No.
The average property investor says, "Oh, my house is up 10% this year." No one asks, well, what would it be if you'd put it in the FTSE 100 or other benchmarks are available? Whatever indice you might choose to invest in the stock market, or what's the return on cash at the bank right now? Those questions don't feature as context. It's just a positive number, and that's all you need to know, which is possibly only half the story.
It is. Let's jump into these charts that you sent us. We usually like a little bit more positivity on the pod, Oli. The most ominous graph, and
there's a question mark at the end of that title.
Ominous graph in property.
Exactly. No, look. I actually think. First of all, I'm a chart nerd for a start. So, but
check.
I do genuinely find this chart really interesting, and maybe a little ominous, and all of that, because to speak let's talk through it for anyone who's not watching. It's comparing the downturn we've got in property right now in property values versus what happened in 2007, 8, 9, and also what actually happened in 2000, because it's worth noting that while you can also go through a downturn where property values only fall 5%, it still took 3 years for them to recover, which I think is also somewhat interesting context. But what we're really seeing right now is, I don't know if either of you guys are old enough to remember 2008, but September 2008 was when Lehman Brothers went bust. And we are effectively in late August 2008 again. Property prices have fallen 20%. albeit on a different trajectory. And now the big question is, where do they go from here? Because they could recover, they could stay flat, and they could also do a second leg down.
It looks, I mean, that the blue line is very close to the orange
we're
line.
Right there,
I mean,
aren't we?
it lines up pretty terrifyingly. When you say property here, is this all
This
commercial
is
or
UK all commercial? Yeah.
so no resi in here?
No resi.
Okay.
No, because the residential property values have fallen 3-4%, something
Yeah.
like that. And that's from a peak probably beginning of this year or about 12 months ago. We are. It's been a very different story. But I do think it's worth noting that the debt market is not what it was in 2008, and the banking market is completely different.
Yeah.
So, the phrase "this time is different" has probably ended more than one career, but it's not the same right now. So, does that graph prove that we know what's going to happen next? It absolutely doesn't, and there's certainly no guarantee that we'll follow the orange line down again.
No.
In 2008, sort of my recollection of it was, again, it was kicked off by higher rates, right? So central banks put rates up quite aggressively, 2006-07 into the early stages of 2008. Then we had a few banking ructions, Bear Stearns, and a few bits and bobs. And then it, as you said, September 2008 when Lehman's went through, that was when it was a kind of a bit of a game changer, wasn't it? And banks were pulling plugs right, left, and centre.
It was effectively impossible to borrow money for some people. The refinancing that you would do on your mortgage actually was okay because more or less the government had to step in on that sort of thing. But for someone owning a commercial property that they had 60% LTV, there wasn't a bank that would answer the door. And let's say let's have another conversation about how we refinance this. I'm not saying it would be easy to have that conversation today, but I think you'd be allowed in the building.
Yeah. There's a lot less debt in the system today.
Yeah.
Is that fair? From both a
Yes, it is.
listed real estate perspective, but also from from the banks as well.
Is that because there's a tendency to fight the last war almost, like?
Oh yeah. Banks have got us 3 times as much capital as they had in 2008 prior to the financial crisis.
Yeah, it's. I think that's a slight mischaracterization. I think they're fighting a good fight, but perhaps not. They are focusing on only one of the issues at hand, right? So it is correct to be keeping a solid balance sheet and low debt levels. That's very rarely a bad idea in property, although there are outliers who think they can sort of chance their arm on it. But it's not the wrong thing to have done. But you're right; it's not the only problem that you have to face up to.
Yeah. Okay. The second chart I really like. Alex, if we're gonna have this one in, please, mate. Basically, it all comes down to interest rate. Can you have a view on property that doesn't involve having a view on inflation/interest rates?
Yeah, I mean, look. So if there's any economists watching, I know this is not a scientific graph.
Hang on, mate. The lines line up really
well,
so that's always a good
allowed
chart.
to do this, but what I've done is taken the dates of this year when there was a GDP announcement or an inflation announcement or the Bank of England changed the base rates, because on each of those days, or at least many of those days, the REIT market, the property companies who are listed on the stock exchange, their share prices went haywire on a lot of those days, sometimes up and sometimes down, as you can see. And for all the fact that those shares were indeed trading on every other day of the year or every other weekday of the year so far, you're right, they line up more or less perfectly. There's a bit of deviation in the mean, but it's the same journey, just with a few less turns and direction.
There was a day, a couple, wasn't it? Not the inflation report we've had this morning, but the last inflation report, the July one, and everything ripped.
Absolutely, yeah, you can see that.
And if it had been beaten up year to date, it ripped even more.
Yeah, absolutely, yeah, exactly. And it's it paints this picture that actually the property world is ruled by the macro right now. That doesn't matter who you are or what you do. Base rates define what your property is worth and where you're going in life.
Is that to the extent where even if it's a warehouse versus a shopping centre versus, is it all trading quite homogenously, or is there differentiation?
The short answer is yeah. I mean and that's what's actually making it quite a difficult market. There are deviations, there are winners and losers in relative terms, but actually the trajectory and the direction of travel that a lot of the different sectors have been on is quite similar. Now, actually one of the things where that isn't true is the industrial market, which is probably the most unfairly hammered sector in the last 12 months or so. It's
industrial sort of factories and sheds.
Theoretically factories, although I'm not sure how many of those we have these days in the UK.
Well,
now it's your Amazon parcel warehouse and every other retailer and everything that goes along with that. So the yields on that were pretty tight. Sub 4% going back 18 months, and clearly you should not be buying property today at a sub 4% yield when your risk-free is 5 and a bit or whatever it is, right? So that's fair. What seems weird to me is that while those yields have moved out substantially, they are 5.5 plus. That's not in evidence in things like the London office market, for example, student accommodation as well, and actually probably the wider residential market. You're working pretty hard to stand still if you're buying a property with a 4.5% yield. Your debt is costing you 6.5%, and you're hoping to make a positive return.
Slim margins there.
So there have been winners and losers, but actually more recently there's been a lot of lockstep movement.
Yeah, let's talk about the REITs, the office REITs, because we can't have you on and not talk about work from home. Probably the UK's second favourite topic to talk about, apart from property prices. These are US office REITs, the big listed ones. The line at the top there that's in positive territory is, for context, the S&P 500, so the broad US market. Just so our American friends don't feel picked on, we've also got the UK here. Derwent and Workspace. And I know that those are two very different entities, but still underwater so far year to date. The thing that's the bears all talk about is commercial real estate in the States, and if everyone's working from home, people won't need as much floor space, and that's going to mean that offices are, space in an office really is going to get really cheap, and that's where the next problem is coming from. What do you think?
Well, there's definitely a point to be made there, right? And I think, first of all, the US graph is an absolute bloodbath. It was, at least at one point, an absolute bloodbath. And
it's ugly as sin.
There's been a degree of recovery since. I think there's a few things to say. So you're right. It's hard to come up with a reason why you would need more. The average company should not necessarily need more space today than it did 4 years ago. I mean, that argument to me seems quite clear. What is less clear is whether that company really needs and can benefit from cutting the space, or whether that turns out to be a bit self-defeating. I think for all that we acknowledge that our building is sometimes half empty or not fully occupied, there's quite a big leap between acknowledging that and then saying, and I'm willing to share a desk with you guys where I come in on a Monday and you have it on Tuesday, and then Jonathan sits in the same desk on a Wednesday. We're not hot punking on submarines here. It's a bit. It doesn't feel like the white collar professional is particularly ready to accept that across the board. So does the company actually benefit from cutting the space by a third or a half? I'm not sure it necessarily does, and it's actually, as weird as this might sound, it's not a particularly big expense. So if you run a financial services company, yes, you're probably paying £70 a square foot for your office space in central London, but this building that we're in is something like 200,000 square foot. So you can do the maths, but it's not quite a rounding error, but it's a very small proportion of your overall expenses. Your wage bill to hire 20,000 people to sit in that space is probably, you wouldn't get 20,000 in, but to hire 2,000 people to sit in that space will cost you as much, if not more. So that's your context. Does the CFO save a lot of money cutting the space in half, or does it just make the business worse? Now, the other thing I think you should also bear in mind is that the US market is a very different one to the UK. And I think so. I did a little bit of research when I saw this graph, and I've been looking at US REITs recently as well. So New York is a bit of an outlier in the US. It's the only city where the average commuter commutes by public transport.
Right.
So
Yeah.
the majority, so something like 55%
Most
of
people
New York
drive.
commuters,
Yeah.
take the metro or whatever. Every other city, you're more likely to commute by car than by train or bus or whatever. And so New York is one thing. You go to Los Angeles or San Francisco or Boston or Chicago, and the car is king. And so suddenly, actually, the topography of the city changes completely, and you can see this quite clearly in San Francisco, where the big tech firms don't tend to be headquartered in San Francisco anymore. They're in Cupertino or Mountain View, Palo Alto, exactly. And the reason being that actually, well, the city's a nice thing to have on your doorstep in some regard if you want to go to the opera or the baseball, but actually spending every single day in the middle of the city is tiring and expensive and not always nice.
No.
So telling someone, actually, would you rather work in downtown San Francisco or Cupertino? Well, it's a drive north or a drive south for me, so I'm ambivalent about the commute, but actually the air in Cupertino is probably nicer to breathe, so that's a net win for me.
That's good. Yeah. Do that.
Exactly.
I put it to you that the best thing that could happen to these office REITs is a recession. Because a recession means that people are in the office. I know we have, and we keep coming back to the same things, but it's totally counterintuitive. But I'm sort of planting my flag. In a recession, people come in to the office, and that means demand for office space obviously goes up, which would be weird, but weird stuff happens all the time.
Right. You don't. Yeah. Perhaps it's GDP would be one way to measure it. You would benefit from some unemployment data that was perhaps a little less.
Robust.
Is the word positive? Yeah. Robust is
well,
the one, right?
yeah.
Because you're right. It's paradoxical, but you don't want to be invisible at that moment in time. And actually, the other weird thing to remark upon, we had some, I suppose you'd call it relatively good wage growth and GDP data in the last week or so in the UK.
Mm-hmm.
The REIT shares reacted pretty negatively, despite historically having a positive correlation with both of those measures, because I guess the argument is that it gives the Bank of England a bit more firepower and gunpowder.
And yields have gone up a bit as well, haven't they, in the last week or so? So that again undermines REITs on that basis. So that's the sort of good news is bad news kind of thesis, isn't it, for the market?
Problem is, I think bad news is also still bad news.
Bad news is still bad news.
There are times in the
most
market
things,
where any news is bad news.
Right.
and we're
Just
probably
there's
one of those now.
we retrofit a narrative to justify whatever the market's doing.
Yeah, I mean, I think about coming back to the office when things get a bit hairy is probably right. And what story of the week, story of the month, story of the year is Zoom getting their employees back in the office 2 days a week, and Amazon doing much the same. So a lot of big companies are going down that route of getting employees back in the office.
There's a real irony in Zoom.
Oh, it's incredible.
Insisting on people being in the office, isn't it?
Laugh out loud kind of amusing story.
They're going to do some kind of AI pivot in the next 2 weeks. Mark my
Bounce
words.
the share price back up to where it was. Yeah.
Sorry, John. Go ahead, mate.
I think I was probably finished there actually.
Cool. Last chart. Don't talk us through
last
this one.
chart, right? Because, excuse me, the story here, right, is so for all that REITs have been a little bit haywire and busy in terms of where the prices have gone. Actually, the underlying value of property has, as you can see in the first chart that I showed you, it came down very sharply, and then it's just trod water. And you can't. This graph doesn't show that particularly well. But what this graph does show is how we got to the treading water phase, right? The stat I like to repeat from this is 23 years of monthly property moves.
Yeah.
Again, all UK commercial property. And there's been 3 months in those 23 years where the price has moved more than 5% a month.
Mm-hmm.
And 2 of them
So one of them was October 2008 when Lehman Brothers went bust, and then the other 2 were Q4 last year. And okay, so you could say, well, Liz Truss maybe has some responsibility for all of that, but actually what it boiled down to was that the people in charge of valuing properties said, we have got incontrovertible evidence that prices have to move. It's not is not based on transactions, because that takes 6 months to sort of
Talk
percolate
a
through.
wee bit more about
Yeah, I
that
was about to
process.
ask that. So, is there a person with a clipboard who walks around an office and says, "What's this?"
And a
How's it
tabard
work?
normally, yeah. No, I don't think that happens in every single case.
No.
In fact, I know
Right.
it doesn't happen in every single case. But you do have to, whether you're a REIT or a property fund or indeed just a private owner of property, you should, and in some cases have to, have your property periodically valued by a chartered surveyor.
Right.
And you can pay pounds to have that person walk around the building with the clipboard, or you can pay pennies to have them sit at their desk and do it on Street View or whatever, which sometimes is enough as well. But what has changed, and historically, so for the sort of 22 of those 23 years, maybe 21 or something, the measure was, what's the most recent similar building that sold in this department. So
Right.
if you own an office in the city, probably 3 doors down, it sold
Something
6
else
months,
has
something else
shifted,
sold 6
yeah.
months ago. And if it's half the size, okay, well, we can factor that in and whatever. But what it means, of course, is that actually you agree a price on a property. The transaction itself takes about 6 months to go through. Right?
Yeah.
And it's slower than your average residential conveyancing process. By which time the price is pretty stale, and then it probably takes you another month or two to let it percolate into your indices and factor in against future prices. What's happened in the last, I don't know exactly when it happened, but probably about 18 months or so ago, was the Royal Institute of Chartered Surveyors said, we're changing the methodology here.
Okay.
We'll still keep an eye on transactions, of course, but it's effectively going to become a DCF model. We're going to take a risk-free rate. We're going to look at the rental trajectory on this, because we know what the lease looks like. We know what, where the market rent that it's likely to revert to is, and we can back out an approximate valuation of it.
Does that mean the property becomes an even more interest rate sensitive asset class?
It probably
More volatile
does.
relative to its previous baseline.
It probably does, and but it also means that you don't necessarily have to wait to see the evidence, see the writing on the wall before you can act. But it's also, it's got a few different quirks to it, because what is also interesting is that it doesn't necessarily capture the value that the marginal buyer is willing to pay, right? And it could be completely wrong. If you could say, look, my risk-free rate's now 5.5%, your property's worth X, but if a tycoon comes around the corner with $1 billion check, that number could be blown out of the water.
You don't hear the word tycoon enough, do you?
I try and slip it
Cigar
in.
in mouth, yeah,
Right.
the hat on. Yeah, because someone might say, right, well, that's cool that you're based on a discounted cash flow, you think that, but I want somewhere to put my money
Right.
that is safe, in inverted commas, and they would be willing to pay a premium if it is, we've had a lot of overseas investment into the UK property market, because the UK is a stable, allegedly political environment.
It's and importantly, it's also a market which has more or less never had any sort of asset seizure, unless there's a really good reason to do it. Right? That's what drives people.
Things get, I suppose.
Yeah, wait and see.
Property, yeah. So talk about housing a little bit. We talk a lot about UK housing, so I'm not necessarily going to grill you too much on that. This stat caught my eye. There are 600,000 more realtors, as they call them, in America currently than there are homes for
I
sale.
saw that. That doesn't make a lot of sense to me.
Sorry, there's more. So there's more estate agents.
More estate agents in the States. than
No
there are properties
volume,
to sell.
no supply, basically. Because
That's-
if you're locked into your mega long mortgage, you ain't gonna move. And the only there's something weird going on with the house builder stocks in the States, isn't there? Because actually they're at all-time highs.
Warren Buffett has just bought in. So the disclosure from Berkshire Hathaway last night was that Berkshire disclosed bought 6 million shares in DR Horton, which is one of their biggest, worth $726 million at the end of the second quarter, and a load of shares in Lennar and NVR, whoever they are. So Warren Buffett thinks there's good news to be had in the US house building, because, and we've come back to this, the US housing market, the mortgage market is such that you take out a 30-year fixed rate, and what's the stat? 50% of US mortgages are below 4%. Well, if you've got a 4% mortgage, you're not going to move house to refinance at
You're
7,
getting
because
5 in your cash.
You're going to sit in your house. So therefore, if you're living somewhere, you're not likely to sell or put your house up for sale. So there's no stock of existing homes, therefore the only stock available are new homes coming onto the market by the home builders. So the home builders have basically got the market cornered, and the volume of new homes is a much higher proportion of the overall sales market in the States now than it's been for years, which is why the stocks of the home builders, and we might have a chart on the US home builders, but I've just got one here actually from the FT email this morning, and they're all up somewhere between 40 and 80% year to date. DR Horton's the biggest, is up 40% year to date.
Rates go from 0 to 5, and house builders are trading at all-time high valuations.
Yeah,
that is absolutely mental.
Yeah.
But what do they do in 2022? That's the
So they're coming off a really low base because
are they at all-time highs? I don't know. Is it all-time highs?
Pass. But they got shredded at the start of the rate rising cycle.
Yeah, understandable. So what you're observing in the chart that Jonathan's referencing is not 0 to 5. It's the expectation to the 5 to the reality of 5.
Yeah.
Is what's actually happened in the last 9 months or so, which is a slightly different perspective on it.
Yeah.
And I mean it's interesting because it's kind of the opposite of what you've got in the UK, right? There's an incentive to keep your home in the US. I suppose as long as wage growth and employment stay robust, right? Because that's what's going to drive defaults or forced sales. Whereas in the UK, it doesn't matter if you've got a job. If you've got a job, you've got a steady salary, that's fine. But what you borrowed 2 years ago is now going to cost you a lot more, and you may not be able to afford it, or your renter may not be able to afford it.
Johnny, Vanguard Mind the Gap survey.
This is depressing.
It's depressing and life affirming if you do our job, I think. So this is kind of required reading, I think, every year. It's a study of the average, basically the return that the average dollar invested in a whole bunch of funds earned. So the actual return that actual investors earned versus the total return of the fund. And the difference in those two figures is down to sales, mistiming, genuinely not sitting along, investor behaviour basically. So the average dollar invested in funds earned a 6% annual return over the 10 years ended 31st of December 22, while the average fund gained about 7.7% per year over that same span, for a gap of about 1.7% annually. What this means is that investors missed out on about 1/5 of their fund investments' average net returns, a significant shortfall. We sit in front of clients all day long and talk about price to earnings ratios, dividend cover, all that good stuff. This is what you are paying us for.
Yeah.
To stop you get that 6% figure closer to that 7.7% figure.
Yeah, 100%. I mean, and I've seen. Barclays Wealth have done some quite good stuff on this. They call it the behaviour and investment gap, or the behaviour gap. Yeah, behaviour investment gap, and they cite a figure of somewhere between 2 and 3% that the typical do-it-yourself retail investor loses relative to what market returns are, and those losses are caused by basically buying high and selling low, or buying the wrong thing at the wrong time. I always have a sort of, to come back to this point, it sort of reminds me of 2006. It's the Clapham Junction railway station advertising hoarding message. So I distinctly remember when I started my career in 2006 that every single station had the New Star Property Fund as the thing to buy, which of course was the total top of the market, the property cycle. 2011, 12, 13, it was all about gold, natural resources, China, emerging markets.
I WhatsApped you a picture
in 20.
Market. I remember in spring of 21, I WhatsApped you a picture of a bus that said, "If you're only thinking about buying crypto now, it's too late."
Yeah.
And obviously, crypto got walloped over the next.
These themes are the sources of this behaviour gap of the typical investor versus what they should earn. It's just poor behaviour, and it's human nature, and we talk about it quite a lot. When things are going wrong and badly and against you, you want to do something, and very often doing something means bailing out. The flip side is when something's going up loads, you've got massive FOMO, fear of missing out, so you end up piling in at the wrong time. And it was good reading. Vanguard do this every year, but it kind of comes back to the point that actually being invested and being diversified and being sensible, actually making fewer decisions, is more likely to get you better returns and closer to market returns than over trading, chasing the current hot fad and bailing out of the things that have gone wrong.
How do you, almost every single analyst who's been on, I've asked, what's your decision making framework to try and avoid, not mistakes, because everyone makes mistakes, right, but try and minimise the potential? I mean, I've sort of jotted down some lessons from reading this Vanguard piece, and one of them is decisions are the devil.
Yeah.
The fewer you have to make, the more likely you are to get a better outcome, I suppose. But how do you think about it?
Well, no, it is hard actually. It's probably the single hardest thing you have to do is you get to a juncture and it's go no go on something. You know, you've done the work and the temptation is always to do a bit more, right? You know, you've got your model, you've done all the Excel work you can possibly do, you've done all the background reading, you've got these stacks of paper in front of you, and you're like, okay, I've got all the information I can reasonably expect to gather.
He's been on the tour around the property and the slap up lunch
Yes.
afterwards. He's done his due
the
diligence.
the quality of the lunch is a massive factor in any solid investment. I'm not being serious in case anyone's concerned there, but it is you do go to the property and it is unusual for me to want to buy any property company that I haven't seen in the flesh. But it boils down to a moment in time where you have to press the button that says upgrade to buy or maintain at neutral, and it's a tough moment. And I will say that in every single time I've ever pressed that button, the next thing I've done is gone, oh, did I really do that? You know, have I? It sometimes involves the odd swear word, which I won't invoke today, but you think, was that right? And then you have to remind yourself, yes, I did everything I could. I've made the right choice here on best evidence. I can't promise it's going to necessarily work immediately, but I do believe it will.
But the other problem with that decision-making framework in general is if you put a stock to buy or you decide that actually don't like it anymore and it comes down to sell, you've got a living real-time number in front of you all day, every day that tells you if you're an idiot or if you're not an idiot.
Yeah, absolutely.
Oli Creasy, not an idiot. For what it's worth.
Just for the record.
Have it in writing. I'll show my mum that. But you're right. I don't think a working day goes by where I don't have a page that looks a lot like the FactSet page that you've got open there, and I just look at it and go, well, what that company there that I haven't necessarily done anything on, but I know where its share price is. It's I've got 30-40 companies that are on that page, and you're right. The difference between someone who's employed solely to maintain a view on that subsector versus someone who's trying to do it all around their day job is quite different.
Final thing on Vanguard. This really caught my eye. I thought this was super interesting. This is Vanguard. Interestingly, we found larger gaps, so behavioural error gaps, if we can call it that. Interestingly, we found larger gaps in areas and styles for which there is robust academic support, like tilting to value smaller company stocks or emerging markets, suggesting that the added volatility these strategies entail cost investors any excess return they might have earned and then some. The same held for more exotic strategies that on paper might push a portfolio closer to the efficient frontier, but in real life confound investors into costly mistakes. Put another way, life does not happen on a spreadsheet.
No. So you're right. So the two things that jump out there: the value factor and the smaller company factor. So both academically in the literature, if you have a small tilt to value and a tilt towards smaller companies, generally your returns over time are better. But what they're saying is that actually for investors, they're more likely to mess up if they're going into those areas. They can't stick it because the journey is very uncomfortable for long periods. As the last 10-15 years will show, it's been a terrible time to be a value investor, apart from a brief sojourn in 2022, right? It's been awful. So anyone who's had a value fund in their portfolio since 2010,
I have huge respect for value investors.
Anyone who's still doing that, must have a lot of grey hair.
Yeah, it's a tough gig. Trojan letter. I don't know if this is going to be any more positive, to be honest with you. So Troy Trojan, really good letter for me to read as much as anything, because I'm sort of an biased optimist would be my bias, I suppose. and their portfolio is 10% gold, 32% US Treasuries, 20% short-dated gilts, and 11% short-dated US Treasuries. So it's never going to be never going to be the most optimistic newsletter. There's a couple of things in here, and there's some charts related off the back of it. So the UK's investment trust sector has been absolutely walloped. This is Trojan. As of the 19th of July, only 22 closed-ended funds out of a total of 367 in the sector were trading on a premium to their net asset value. This compares with 105 trading on a premium in 2021. Do you want to talk us through premiums and discounts in investment trusts, John?
Yeah, well, I mean, it sort of overlaps with what Oli does, really. So every investment trust has a bunch of assets in it. It's ultimately a company full of assets, and those assets have values, and you add them all up, and then the trust in total has a net asset value. The share price trades in the market, often at a divergence to the net asset value. Now, in theory, if the share price should be pretty close to the value of the assets in the company, otherwise there would be an arbitrage opportunity. But as the chart shows, there are times when investment trusts trade at discounts. Why might an investment trust trade at a discount? Well, maybe investors don't believe the value of the assets in the fund. So whether that was office properties in Oli's sectors, or infrastructure, or private equity, or doesn't matter what, then you get these periods where you get these discounts. And we've talked a bit about before about the so-called panic euphoria and sentiment. And interestingly, investment trust discount premium charts in totality is quite a good sentiment indicator. So when trusts are at big discounts, as they are today, that tends to be representative of a market that where sentiment is pretty fragile and pretty poor, and that's exactly where we are. And it's again, it's another kind of more evidence of interest rates going from 0 to 5.5%, 6% is causing issues in the investment trust sector. Is one of those.
One of the knock-on impacts of the investment trust sector being beaten up is the FTSE 250's been beaten up as well, because there's quite a high skew of investment trusts in there, isn't there? You sent these charts across, John. Basically, the TLDR is the 250 looks quite cheap.
Yeah, UK mid and small caps look as cheap as they have done for, as far as the chart go back, 20 years. And typically, small and mid-cap companies tend to grow faster than the largest companies historically. So therefore, if you can buy them cheaper and they grow faster, you tend to do better over time. The FTSE mid-cap UK small-cap equities from around 2000 to 2018-17 outgrew the FTSE 100 at a phenomenal rate. But since then, it's been kind of all the other way. So. Yeah, I mean, you might need to wait a while for this to wake up again, but there's definitely some value in small cap. You have
a fairly substantial margin for error built in there at those valuations if the world doesn't completely end.
Yeah.
So one other thing I think I picked up on this letter, the danger of the picks and shovels thesis, which is something that feels quite timely at the moment given what's going on in AI and NVIDIA in particular. So talking about the dot-com bubble, this is Troy, I should say. Back then, investors coalesced around a small number of telecoms equipment companies, including Cisco, Lucent, Ericsson, Nortel, and Marconi. These stocks would, the story went, benefit from building the infrastructure for the internet boom without investors having to identify the dot-com winners. Valuations for these companies reached eye-watering levels of 50 to 100 times earnings, discounting growth that ultimately failed to materialise as the bubble burst in America headed into recession. Got a chart on screen here of Cisco going back to November 1996 to the current day. You can see the run up there into the dot-com bubble in 2000. We've talked a bit, I think we talked about Microsoft on this as well, John, previously, but Cisco was not a bad business.
No.
But if you paid too much for it, I mean, it's still not back to where it was.
No, and it fell from $90 to less than $10 over the ensuing 2-3 years from the peak in 2000, and it was trading on 50 times sales, 40 times sales, and it's funny that the list of names that you mentioned there, half of those don't exist anymore, do they? Ericsson, Marconi definitely doesn't exist.
Never heard of them.
No, well, exactly. So you need to be quite careful, don't you, in speculative mania, that you're not getting kind of drawn in. It comes back to that point earlier about investor behaviour and FOMO. This was a classic FOMO stock in the late 90s.
Yeah, it's not necessarily to pick on NVIDIA necessarily. There will definitely be winners, but you can't sort of say, well, I'm not taking a view on the picks and shovels thesis will be competitive. There will be winners and losers within that. So you're not necessarily getting rid of risk by going to the infrastructure place.
For what it's worth, by the way, the valuation on Nvidia is not as egregious as it was on Cisco in '99. Just for the record.
Is it a value stock, John?
Relatively.
No.
relative to 100 times earnings. Okay. So final thing. We wrote in January. Again, this is Troy. We wrote in January about stock market participants' insensitivity to valuation after 14 years of historically low interest rates. Akin to the proverbial frogs in boiling water, higher multiples of earnings have become the norm for investors. I wrote something about this week. Leaning too heavily on historical valuation models can get you into trouble. And the one that I showed as the example was the Shiller-Cape ratio, which is eminently sensible. But if you sold it on the basis of overvaluation back in 2010,
10, 11, 12, yeah.
which was screaming overvaluation relative to history, you've missed out on one of the best decades for US equity market returns ever. So, I get the point about valuations, but things change, and I know that's such a noob
you're
thing
also
to say.
comparing apples and pears, aren't you? Because if you look at the Cape, what did we do in the 70s? Well, we made stuff and we bashed metal and we made widgets, whereas today we make software and tech and lots of other things. So the world has changed and companies are different, and therefore relying on same valuation models across industries and across time is probably not very sensible. The valuation is still a good anchor and a pretty good guide for us. It's not something, and I think that the point they're probably trying to make was that if interest rates are naught, paying 20 times earnings for the US equity market might seem fine, but if you can get 4.5-5% on a US Treasury, where's the incentive? Why should the S&P be on 20 times? And that's probably where I kind of lean. It's fine in 2020, 2021 when interest rates are naught to have to buy equities because, as we talked about, in those days we talked about TINA, there is no alternative because there was no alternative to equities because cash was yielding you naught. Today, as we've had the conversations with clients, there is an alternative and you can buy gilts or you can put your money in the bank and earn a perfectly sensible return. Maybe not, double digits and not brilliant, and we would still expect equities to do well, but why should equities be quite so expensive in an environment of higher interest rates? I don't know. So that's the sort of the conundrum of markets at the moment, which is probably to get to the point of what Troy are trying to say.
This chart, rather embarrassingly, I've put the wrong acronym up. It should be TINA rather than TINA. But anyway, if you'd have showed me this chart 2 years ago, I'd have gone, what on earth has happened? Because this is showing green bars, yields available from corporate bonds in every market globally apart from Japan are now higher than dividend yields.
Yep.
Which is night and day from where we were a couple of years ago, obviously.
Yeah. Dividend yields were much higher relative to bond yields, and that's because interest rates have gone up, and that's what the world continues to grapple with. And ultimately, whether it's the property world or the wider stock market or crypto or residential property, it doesn't really matter. Interest rates are the kind of main driver on that.
What do you think about rates?
That's a big question.
I know. It's my finishing salvo, so I thought I'd go for the throat.
I mean, I don't have that much to think about them except that it's caused the property world a lot of grief. But that I think, well, certainly my world has been more or less rational about it. You have, as Jonathan said, you've got a higher risk-free, you've got a new paradigm to work within. Values have to change. I actually, the strangest thing for me is the fact that residential prices haven't moved. Right, that is I can construct an argument why they haven't or why they maybe shouldn't, but I still don't think it's entirely correct. If a dispassionate commercial property buyer decides that his property or her property has to be worth 20% less, then why does that argument not apply to any other asset class ultimately that's valued off of its income, including some residential property? It's coming.
this, I imagine he watches the show. This is a direct appeal to Andrew Bailey. Please stop putting interest rates up. My tracker mortgage is becoming eye-watering.
I think the big takeaway is that Oli Creasy sees UK residential property down 20%.
I mean, that's what we've got to. That's what we've got to call the pod this week. Like, nothing gets people going like property market bear.
Don't do that to me. I'll be getting death threats on X.
It won't ever get that bad. The Bank of England and the government have shown time and again that they will backstop the property market.
I do agree with that.
Maybe that's very. I mean, I could play that back to me in a year. But it's absolute carnage out there.
But actually, it's also not a rational market, and I mean that respectfully. I don't mean it's run by people who are themselves irrational, but the decisions they're making are not solely financial.
No, they're not done in a spreadsheet in the way that industrial is.
Exactly. Yeah, you're thinking about your kids' schools and how you need a third bedroom for your home office or whatever it is that's driving your decision to buy or sell a home. And yeah, the mortgage rate is one of the factors, but it's far from the only one.
I always admire your decor choices when you're on Zoom.
Well,
is that Mrs. Creasy?
Those are my wife's decor choices,
Okay.
absolutely. Yeah, but I deserve the credit for not interfering. I think knowing where my expertise.
That brings
lies.
us nice full circle. Decisions are the devil. Don't get involved.
Right.
Ollie, thank you so much, my friend. That was great fun.
Thanks for having me.
Johnny, thank you very much.
Till next time.
Thank you for joining us, folks. We'll see you in a couple of weeks when we've got Hughesy back, I think, if he decides to come
He
back.
might be tanned.
If you've got any questions, give me a shout on david.henry@quiltercheviot.com. Thanks very much.